Well, hey there, everyone. Happy Wednesday, May 13th, and welcome to Chart This with Dave Keller. I asked you to be flexible. I appreciate you doing so. We can get to the show right about now. We did make it safely from Seattle to Boston today. Pretty easy, yet turbulent flight, but we made it. Got some good work done on the plane, and good to be here back in Beantown. Those of you that are from Boston, by the way, or are familiar with the city, I'm staying out in the Seaport area, which when I lived here, like 2008 to 2016, this was a bunch of parking lots and a whole lot of nothing. It was like industrial space that was just kind of left over. And they talked about turning it into a really cool area. Man, it has happened. I mean, it may be the coolest part of Boston all of a sudden. Um, Pretty awesome. So good to be here. I'm here for the CMT Spring Summit happening Thursday and Friday, and it will be great to connect with some members of the technical analysis community from around the U.S. and reconnect about charts and markets and all those things. I'm going to do my best to get you a show today, tomorrow, and Friday, and then travel back home to Seattle on Saturday morning. So appreciate you being flexible as I try to carve out some time to share some thoughts with you. Thought I could pull this off live here at this time, so I hope this works okay. And if not, my apologies, but there should be a good replay on our YouTube channel. I'll make sure that that uploads pretty well in case you're having any issues with the live stream. We are live streaming right now on Facebook, LinkedIn, YouTube, and X. Thanks to those of you that are tuning in a little later than normal to catch my perspective. And I hope that it makes you think a bit. Interesting day today. We are continuing the theme that we observed on Monday and Tuesday's session with, large over small, with growth over value, with the NASDAQ composite ripping to the upside, even though Titus Ryder, as you correctly said, PPI way higher than estimates, similar to the CPI number yesterday. Both of those finally reflecting the uncertainty that this situation in the Middle East is causing. Market does not even care. Now, it depends on where you're looking. And I would tell you the market is showing a lot of sensitivity to what's happening in the Middle East. The market is showing sensitivity to higher interest rates and inflationary pressures and everything being more expensive than it was a couple months ago. It's in the breadth indicators, right? The weakening breadth conditions, the stocks making new 52-week lows. That's where you're seeing the message. But we have a number of different things happening. We also have a raging euphoric rise in the AI stocks, and that strength, that euphoria, that optimism that is going to keep going is outweighing clear signs of economic instability. And that is the push and pull we have in the markets right now. That's what we're going to see on the charts. And that's what I'll walk through with you here now. As always, we'll look at the market averages. We'll check out some of the heat map and look for some individual stock and sector themes. And we'll finish off with some charts that I have hand selected, hopefully for your pleasure and benefit. The NASDAQ composite leading the way higher today, up 1.2%. The S&P up 0.6%. We've now closed above 7,400 with room to spare at 7,444. New closing high for the S&P. The Dow getting closer to 50,000, but not today, actually down slightly. And what was interesting is, the S&P, the NASDAQ, and the Dow all went negative right out of the open. I think that's another thing to realize, right? Right there's your reaction to the PPI number. That first 15 minutes of trading where the NASDAQ opened lower. From then on, the optimism, the euphoria. I keep using the word euphoria and euphoric. I think that is a very fair way of describing the current market sentiment, particularly in the technology sector. So the NASDAQ just lights out positive. So the Dow recovered as well, just not enough to get above yesterday's close. Mid caps and small caps also recovering in the afternoon, but both underperforming the S&P and certainly the NASDAQ. Volatility remains pretty low here, right? So we opened up with stocks lower and the VIX pushing above 18, but through the course of the day actually went slightly below 18 to drift further to the downside. So, VIX in sort of the mid upper teens, pretty good volatility area, pretty good spot for the VIX to be in a kind of classic bull market environment. Looking at rates, we're seeing rates continue to push to the upside, right? So you've got a bunch of different, a number of different things going on right now in the world. And I would say there are two kind of general themes as we outlined, right? There's the negative impact of inflation, interest rates, higher crude oil prices, geopolitical events in the Middle East, the instability. I think all of that is kind of one bucket. I mean, differences there in some of those themes, but all kind of that general kind of sandwich. And then over here we have the others, which is growth stocks reporting blowout earnings, having great quarters, raising guidance, raising revenues, raising earnings, making an absolute killing, spending aggressively, but also profiting aggressively from those investments. And the optimism is there. And so that optimism is outweighing the fact that rates continue to go higher. If you told me there's a situation in the Middle East, we're not getting, a real peace deal sign. It looks like it's taking way longer than expected. We were told it would take a couple weeks. Now it's been a couple months. I would say markets are probably going down at that point, particularly given crude oil prices at $100 a barrel. Not happening, even though rates pushing closer and closer up to 4.5% on the 10-year yield, which is a level we've not seen in quite some time. Long bond yield above 5%, now at 5.05 today. You would think equities would be down, and again, a lot of equities are, and I think that's what you have to remember on that geopolitical, economic data, inflation side. A lot of stocks are not looking particularly great right now. And a lot of areas of the equity market, particularly breadth, I think that's where you see the concern. Again, it's just the euphoria outweighs what we're excited about is outweighing at the moment what we're nervous about. That may not hold, but that's what's holding right now. Dollar moving higher along with interest rates. That's kind of a risk off signal. Bonds moving lower as a lot of the equity indexes did. Commodities actually came off a bit today. You can see crude oil prices actually slid lower. The USO was down 1.6%. The DBC, which is a broad commodity ETF that we like to track, down about 1%. Gold price is actually lower by about 0.5%. Silver finishing higher, as did natural gas. So it's kind of mixed results. Continued strength in the soft commodities, corn, wheat, soybeans continue to be areas where we're seeing some impressive upside rotation. And I would argue, clear signs of accumulation. On the cryptocurrency space, not great. We can see that Bitcoin's pushed back below 80,000. I would say on the chart of Bitcoin, which I did grab to review in a bit, you'll see that we're facing the 200-day moving average and failing to get above there, right? And we have a market in kind of a primary uptrend. And I would argue Bitcoin's kind of there. You look for those kind of key thresholds, right? Those key levels where you really want to see validation with a break above that, like a Fibonacci level or a clear round number or a 200-day moving average. And I would say Bitcoin over the last week has had an impressive rally to the 200-day, but not through the 200-day. And now we're seeing a bit of a risk off flavor on that particular chart. All right. I didn't bring an external monitor, so sorry if I glitch around a little bit. I'm kind of going between 3 different screens, looking at charts, looking at the live stream, and looking at your comments. So we'll make it work. All right, 50-50, kind of a coin flip. If you look sector-wise, the technology sector, the XLK, the strongest. That's not new, right? Up almost 1%, leading the way higher. Noteworthy that the NASDAQ Composite did even better than the XLK today, up over 1%. Communication services, number 2, up 0.8%. Healthcare, up 0.6%. We highlighted healthcare on the show yesterday. We went through the XLV and then some of the kind of industry ETFs covering pharmaceuticals, biotech, devices, providers. And would encourage you, if you missed that, go back to yesterday's episode. Going through those, I think, was really helpful. And I think there's a great framework to think about as we outlined on the show, looking at the sector, but don't think of healthcare as just the XLV. That's actually pretty weighted to some of the larger names. There's kind of a pharmaceutical overweight in the healthcare ETF, the XLV, but you have individual industry ETFs, a lot of them pretty liquid with pretty decent volume and decent AUM that can help you understand the kind of structure of the next level down, right? Kind of the group and the industry level in healthcare. Enough today to push the XLV up 0.6%. I did grab a healthcare chart that looked pretty awesome earlier today on the plane, and I'll show that to you in a little bit. On the downside, utilities continuing to lag. There's a growth story with utilities that has been, something we've talked about at times during the cycle, but not recently. Utilities trading much more like a kind of a classic defensive sector. So I feel like for now, at least, that narrative of utilities are a great growth story and it's just like buying tech I'm seeing the XLU down today. Financial sector down as well, 1.1%. Real estate, third from the bottom. Breath conditions continue to be really uncomfortably not great. And I grabbed a tweet from a fantastic strategist, Jason Geffert, whose work I've followed and have appreciated for many, many years. I'll share with you his take on the weakening breath conditions. By the way, latest episode of the Market Misbehavior podcast with Dean Christian's really, really good interview. We got that out just earlier this week. Please go back and review that one. He's a really he's one of those strategists. There are strategists like me. I'm not a data cruncher. I love looking at charts. I love the visual aspect. I love the psychological aspect. There are people like Dean who are more statistically driven. He just has a ton of models. He has a ton of data that's crunching to yield some really interesting perspectives. And I find his work and others like him to be really great as a complement to how I think about things. Often a little more subjective. His is much more of like sort of an objective roll up on a ton of data. And I thought his comments on new lows were really, really interesting. So make sure you tune into that recent episode of the Market Misbehavior podcast. That's on our YouTube channel, also on all the podcasting platform these days. All right, so the breadth conditions today, again, continuing to be underwhelming. We're at 61% decliners on the NYSE, on the S&P 500, as well as mid caps and small caps, all about 65% down to 35% up. So a 2-to-1 ratio, decliners versus advancers. So make no mistake, the indexes are going higher. The NASDAQ is driving higher. It's technology and arguably parts of technology, right? It's semiconductors and other AI trades, and then a little bit of software that looks pretty good. And other than that, I mean, this market is looking incredibly weak, right? Relative to most historical cycles. Quick check-in on some of the mega cap leadership names here in the Magnificent Seven. I'm actually hosting a panel on Friday at the CMT event, and I emailed the panelists just to talk about, share some ideas of topics I'd like to go through with them. And one of the things that I plan to ask them, and I will happily share the answer to the question after the panel, but I'm going to ask them, look, the Magnificent Seven, it's now a couple magnificent charts and a couple of very much not magnificent charts. So is there a new paradigm we should think about for leadership, right? Or there's some consistent themes and a better label? Magnificent Seven seems like a dead group in a lot of ways because there's just too many names in here not looking great anymore. Having said that, Alphabet is one of those that still looks pretty good, up 4% and leading the way higher. NVIDIA, Meta, Tesla, all up over 2% today. On the downside, a couple of these were lower. Microsoft continuing to underwhelm, really stalled out around 430 and then rotating lower. And Broadcom, again, kind of holding up. Like Microsoft and Broadcom aren't horrible charts. They're kind of holding up here in the last couple of weeks, but they just kind of lost their upside momentum compared to something like an Alphabet that just continues to impress to the upside. All right, let me get the heat map going here. Appreciate all of you, those of you tuning in live. I see some familiar names and faces. I appreciate you guys joining me here for this late kickoff. We're live streaming on Facebook, LinkedIn, YouTube, and X. And I appreciate you guys tuning in. You are welcome to ask questions as we go. I will take a look back at some of the questions and maybe take one or two before we finish the episode. If you're watching the show later on our YouTube channel, hey, drop a question in the comments section. I read every one of those questions that comes in and enjoy doing so. And we'll happily answer some of your questions there as well. All right, let's look at the heat map, shall we? Go with the heat map. Let's start off looking at some high-level takeaways. I mean, this was not a great day, right? And if you cover up Alphabet, Meta, NVIDIA, you only have to cover up a couple big mega cap names, and then the rest of this day did not look particularly good. You can see a lot of the negative action, right? The brightest red kind of concentrated in the financial sector, in the healthcare sector, which is interesting because this is one of the top performing sectors. But I think what's happening in healthcare is a great illustration, a great sort of representation of what's happening widely in the equity markets. Not everything looks good. And there are bull markets where it's like breadth is strong, trends are generally strong, and they can be a challenging market because how do you figure out which stocks to own when everything's kind of going up? We are not in an everything going up situation. I think it's pretty straightforward which charts look good and the multitude of charts that do not look good. And that concerns me because I'd feel better as a strategist and as an investor when more and more stocks are participating. I'm not getting that vibe. And I think within the healthcare sector, you're seeing that, right? Eli Lilly up 2.6%, Johnny John up 2.8%. Then you have a bunch of things that were kind of flat to down a lot, right? And if you look at some of the charts like Mettler Toledo, I mean, absolutely falling knife situation, down another 4% after dropping through the course of this week as well. So it's really mixed results in a lot of these sectors. Again, technology is the only one where you really see, I would argue, a concentration of really constructive charts. Elsewhere, it's really hit or miss. Lack of strength in financials is also an issue. Can the market rally without financials? That's often a question I get when the market rallies and financials are going down. And if you look back in history, the answer is yeah, it can. Generally speaking, do we feel that better as investors? And does the data back up that more often than not, financials generally tend to produce well, right? I mean, yeah, so that they tend to be kind of a part of that kind of bullish theme in a classic bull market. If you have like the script of the kind of normal market, a normal bull market, quote unquote, financials would probably be a part of that. So is it less than ideal that financials are generally drifting lower? Like, yeah, I think that is, along with the weakening breadth indicators, just one of those signs that things are not as good as the chart of the QQQ would make you think. Elsewhere, we're continuing to see weakness in kind of home builder and home improvement related names. Pulte Homes, PHM, is showing up on my new 3-month lows list today. We've highlighted that recently because those are generally tied to interest rates. And we're seeing the 10-year yield move higher given, reaction to inflation and the CPI and PPI numbers coming in higher than expected. That's pushing rates up a bit as the market is pricing in potential rate hikes through the course of the year. Not anytime soon, but months later, right? Getting into like the third quarter, maybe fourth quarter, pricing in a couple rate hikes is what the futures market is now pricing in. Higher rates just don't tend to be good for home-related things. It tends to mean mortgages are more expensive. And that's certainly, that is one relationship that is making a ton of sense right now. I would argue not everything's making sense. That's one that makes sense to me pretty good. And then finally, in technology, I feel like my standard PSA, right? There are stocks that do not look good in this sector. So please don't think of the strength in technology, meaning all tech is good. Not all tech is good. And particularly in the software space, charts like Intuit, charts like Accenture. I mean, Palantir is not a good chart. Like, it just really isn't, right? I mean, and is it the worst chart I've seen? Like, no, but is it in an uptrend? Absolutely not. I would argue there's been a clear rotation from a bullish phase, an accumulation phase on like the left half of this chart, to more of a sideways phase in the middle third, and then a clear distribution phase, right? We've broken through all the moving averages. We most recently broke through the 200-day and then a couple failed attempts to regain it. The momentum's now clearly in the bearish range and we're rotating lower. So back here, I'm told Palantir is like the future, and all we need to do is have a one stock portfolio of Palantir, and that's it. And that uptrends, often will not last, and there will be changes. And I would say in this kind of period, you don't need to have a crystal ball to know the peak in Palantir. I don't think that's as important as some of us think it is. What is important, I would argue, is recognizing a change, recognizing what I call a change of character. Look for signs when stocks no longer hold moving averages. We start to see that with the 50-day failing here in November. Watch for when stocks don't see buyers coming in on dips and we end up making new swing lows. Watch when a stock has been above the 200-day moving average for years and then stops being above the 200-day. Watch when the momentum shifts from clearly bullish to clearly bearish. And all of those things usually result in the relative strength being underwhelming. And for the last 6 months, you've underperformed the S&P in a big way by owning Palantir. And so Palantir, I think, is a great cautionary tale of, and again, I remember all of this argument about how Palantir is like the next thing. And it's like, that's the poster child for this perfect raging bull market, and now other kind of AI related things are looking a lot better. At some point, PLTR is going to recover, but that day is not this day. All right, I got a little soapboxy there, but I couldn't help myself. We are going to continue on looking at some charts that I've hand selected. Before I do so, I do want to give a shout out to my friends at Seeking Alpha. If you go to marketmisbehavior.com/Seeking Alpha, They are offering my viewers 10% off a new account. We've got some pretty cool premium tools and techniques at marketmisbehavior.com/seeking alpha. You can learn more information about their what they call Seeking Alpha Premium. They also have a pro level where you can take your portfolio to the doctor. They call it a portfolio health check. You can access their quantitative model and all sorts of other good stuff. Pro tip, by the way, they also have a product called Alpha Picks. And if you go to marketmisbehavior.com/alpha picks, they are actually just preparing, I think it's either later this week or the beginning of next week. The head of their quant team, Steve Kress, will present the second Alpha Pick for May. It'll be a live webcast only for Alpha Pick subscribers. And it should be really interesting. That's where they hand select one of the stocks that scores well in their quant model. Then they dive deeper into momentum, into valuations, into earnings, into the fundamentals. It is a great way, I would argue, to learn more about that discipline of using quantitative processes and more subjective analytical process as well. Find more info at marketmisbehavior.com/seeking alpha or marketmisbehavior.com/alpha picks. And thanks so much to my friends at Seeking Alpha being a partner to Market Misbehavior. All right, before we get to the charts that I've hand selected to review with you, I do want to give a shout out to Jason Geffert. I followed Jason's work for a number of years. He actually started a firm called Sundial Capital Research and also had a retail product called Sentiment Trader. I subscribed to his service for years, enjoyed meeting him, enjoyed following his work closely. He was always fantastic back in my Fidelity days, weathering questions about all things breadth and sentiment. That's sort of his bread and butter. He's been on fire on the Twitters, highlighting the concerning number of new lows. And earlier today, he pointed out, and this is quoting Jason's tweet here, but this is the most new lows within the S&P 500 on a day the index poked above a prior all-time closing high ever. So this is the most new lows we've ever had on a day when the S&P is making a new all-time high. That's today. Over the last couple of weeks, he's been highlighting, wow, this is one of the 4 worst days. This is one of the 3 worst days. This is one of the 2 worst days. Today, it literally is the most new lows we've seen. I highlighted an indicator called the Titanic Syndrome. It has not fired yet, but it is based on this general premise. When the market's making new highs and a bunch of stocks are making new lows, buyers beware is something that Jason and many others whose work I've followed and trust have pointed out. So shout out to Jason. Continue fighting the good fight, my friend. And I appreciate it. I also want to share a quick note. I had the Market Misbehavior newsletter went out. And one of the stories I shared recently, if I remember right, was about the Fidelity chart room, which I'm excited to see in person tomorrow for the first time in a couple of years. It's I used to run that group that ran the chart room. I had a lot of really good experiences there. In my Fidelity years. It would be great to be back and see some of my some of my former colleagues, I should say. One of the great stories from that space, though, is we would have wall-sized paper charts. The chart room when I was involved was a lot bigger. We had a much bigger footprint, a ton of big wall-sized paper charts, and they still do, and a lot of really good visualizations. But back in the day, it was a huge footprint, and I remember when the market would go up a ton, the market would literally go through the roof of the chart room because it would go off the vertical scale, kind of like what you're seeing with the S&P, right? I created this kind of stoplight, this traffic light visualization. We keep going above the upper end of the chart. So I have to keep bumping this, this shaded area up to reflect the fact that we've gone higher. And I would see times when the market would be so strong, they would actually have to reprint the whole wall and kind of bring the scale down a little bit so that they had enough room because the market was going up. And I remember the first time they did that, I thought, uh-oh, that's a bear sign, right? That's a contrarian bearish signal because they had to reprint the wall. What I learned over time in raging bull markets and experiencing bull markets in 2014, 15, like 2011, like these big kind of recovery years where we had these raging upward moves, I realized that the signal wasn't when they had to reprint the chart. The signal was when they didn't have to reprint the chart anymore, right? When that uptrend is going, you just keep printing, you just keep adjusting the scale and recognizing we're in an uptrend. When I have to stop bumping this little green shaded area up because we stop making new highs, that's the contrarian signal. That's the sign that we're nearing maybe an exhaustion point. So For what it's worth, I'm still bumping up the chart, the virtual chart room that I share with you here every day. Still kind of in a bullish phase. I'll let you know when I have to stop adjusting that chart higher. For now, we're in good bullish trend. We're making higher highs, we're making higher lows. The momentum is strong until proven otherwise. I'll tell you what, Jason Geffert and others whose work I follow, and in my own process. I mean, what concerns me right now is the weakening breadth conditions. Right, this is a chart looking at the last 12 months with the S&P making new highs, with the advanced decline line on the New York Stock Exchange actually making a new monthly low today. The percent of stocks above their 50-day is down around 46% now, down from 62% just a couple weeks ago. The bullish percent index is down around 51%. That was at 67% a couple weeks ago. The defensive sector of consumer staples has been outperforming the offensive sector of consumer discretionary. So this is at times has been one of my favorite risk charts, right? Tracking kind of key risk metrics. When these lines are going down, I've learned to be wary. And so I remain wary. I remain following the trend. I own plenty of stocks, but I don't feel great about what I'm seeing on this chart. And one of two things happens in this situation. What happens more often than not is the price of the index starts to roll over, and just basically the weight of these negative breadth readings and sentiment readings just really start to weigh on whatever's been working so well. That's the more common outcome. The less common but possible outcome is that all of these things start to turn up, which is why keep watching the show, keep following my work. I will let you know if I start to see some positive rotation here, but man, I'm definitely not seeing it right about now. Let's see here. I did quake a question here. Let's see. I'm going to extend the trend line you have on that channel. I think you were talking about. Well, apologies. I'm not able to see. I'm not sure exactly what. Maybe this you were talking about. I apologize. As someone who asked about the trend line, I'm sorry. I missed it. If you remember what chart I was showing, keep in the comment section. Let me know. It was Edward. You said, why not extend that trend line you have on that channel? Would you mind just telling me what chart you're looking at? And if I can pick that up before the end of the episode, I will show you what I mean there. All right, let's continue on here. So breadth not great. Here's the new lows. This is what Jason Geffert was talking about in his work. These are the new 52-week lows on the New York Stock Exchange. That's right. And then the bottom panel, the new 52-week lows on the S&P. So today, for example, we had 35 new 52-week highs in the S&P. Those are mostly in technology. We had 43 new lows in the S&P 500, and those were in a bunch of other sectors. So that's about what, 8.5% of the S&P made a new 52-week low, while 7% made a new 52-week high. That's just not a great number. And this is not exactly the Hindenburg omen, but this is one of the things the Hindenburg omen looks for, is that a bunch of stocks are making new highs and a bunch of stocks are making new lows around the same time. We're kind of seeing that similar kind of Hindenburg omen vibe. Not all of those boxes can be checked right now, but it's very, very close. So again, we're seeing conditions that are very similar to classic topping methodologies, looking for the market making new highs or in a clear uptrend, but this evidence, particularly breadth, not confirming. And that's where the Hindenburg omen, the Titanic Syndrome, and other indicators I probably don't know the names of off the top of my head are all built off of that particular sort of warning sign. VIX remains low, right? So, I mean, things that are good. I mean, there are plenty of things that are still good. I mean, most importantly, the indexes are going higher, right? The S&P and the NASDAQ are making new highs. That's bullish. That is generally bullish. Volatility remains low. That's bullish too, right? So it's not like everything looks horrible here. The VIX looks pretty good. The VIX looks kind of where I would want it to be. If you asked me to script, like, Dave, what does like a strong bull market kind of look like? I would say we're making higher highs and higher lows. Volatility's low, breadth is strong. We don't have the breadth strong piece, which is, again, what I've mentioned, but we do have low volatility. And so, again, not everything is flashing warning signs. VIX is remaining around 18, which tells you the options market's still pretty good. The MOVE index, which is the sort of like the VIX for the bond market, still pretty low, right? Relatively low. So volatility signals generally pretty good. You know, we are seeing some sentiment readings getting to some extremes. On tomorrow's show on Thursday, we'll update the AAII survey and the name exposure index. This could be a really interesting week for those because the market has just accelerated to the upside, but because there's such narrow leadership here, I'm curious what the sentiment readings will be if either of those get to kind of euphoric, super, uber bullish, arguably too bullish levels. The one sentiment indicator I do want to share with you today is the put call ratio. And there's a couple different versions of this that are tracked. I'm looking at the total put call ratio. So that includes equity options and equity index options all wrapped into one. The gray is the raw data. The put call ratios are actually a pretty noisy daily data series. So I usually smooth it out with a 5-day moving average. That's the pink line that you see. It's just a 5-day moving average of the raw data. And I just do that to smooth it out, but I will pay attention to those readings. When the put call ratio spikes really, really low, that's pretty common at major tops because basically the call side, right? So the lower the ratio, the more calls versus puts. That means there's a lot of bullish bets being made, and that usually happens going into a major peak. The last time we had a big drop in the put call ratio was back here in April. Did not end up being a price correction of any meaning in the S&P, but it really was a bit of a time correction, right? We had this big move higher. We kind of stalled out for a week and a half before we continued the uptrend. We kind of see this, 1, 2, 3, like 3 different distinct periods on the chart for the last 6 weeks or so. The put call ratio is getting back down toward those spiky levels, and what that means is maybe the sentiment is so bullish here that it might be negative. So that's one thing that's getting to kind of warning levels. I'll check in on the sentiment readings tomorrow. Those are weekly readings that come out on Thursday morning, so we'll update those on tomorrow's show. Here's a chart of Bitcoin. I mentioned, great to see all these rallies. Great to see the push above 75K. That was a real signal for me. Great to see the momentum relatively strong, and all of that's still right. We're still making higher highs and higher lows, but we are stalling all out at the 200-day moving average. We actually reached the 200-day about a week and a half ago. Bitcoin's sort of remaining sideways, if not tilting slightly downward. So Bitcoin's actually following breadth indicators here. It's almost like the true trend in the market's actually slightly lower, and the S&P is kind of dominated by the AI trade that is still looking kind of artificially amazing, is the way I'm thinking of this. So Bitcoin is more of I think is really telling you what the sentiment is doing, which is starting to roll over a little bit. And so I think Bitcoin above the 200-day lights out positive, but it's not there yet. I'm also seeing some divergences, not a ton. And this is another thing I look for as a way of validating or anticipating a major top. Two things that often happen going in to a major market top that are early warning signs. One would be weaker momentum. The other would be weaker breadth. And in terms of weaker momentum, the momentum on the S&P 500, the momentum on the NASDAQ still pretty positive. The momentum on Broadcom, not great though, right? We made new highs April into May. We're seeing weaker momentum. So if I see more of this kind of chart, that's actually a dangerous sign. Broadcom today is actually testing its 21-day EMA. That's what I often use as an initial stop. Broadcom breaks below 400. All of a sudden, that looks like maybe the validation of a short-term top. This bearish divergence is kind of signaling it. So for me, for Broadcom, I'd probably be holding off a bit personally. I don't trade this stock on an individual basis. I don't think ever I've owned this one, probably through ETFs that I own, but I don't make a lot of individual bets on charts like this. But I would say for me, this bearish divergence is enough for me to say, okay, let's hold off and see if we can reinitiate an uptrend on stronger momentum. That's what I would look for. Gen Digital, ticker GEN, great gap higher and then continued upside. This is one of those software names that lagged behind in such a big way from summer of last year all the way through an April low. Serious downtrend, moving averages sloping downwards, negative momentum. All that's changed here in the month of May. We gapped higher on earnings, and now we're seeing additional upside. I call that a gap and run. Gap above the 50-day, additional buyers. I think that's a great chart. Strong momentum, improving relative strength. Those are the charts in technology that get me excited. The really overextended ones that feel like they've already had their run, less optimistic. These kind of charts showing some rotation, encouraging. Freeport-McMoRan, obviously not in technology. This is a mining stock, but note the gap lower. This has been just like a whole gap party in the last 6 weeks. Gap higher in April, ends up pushing the stock back up to test previous all-time highs around 70. We have a gap lower here, continued deterioration. Then we have an upside gap. And I love the follow-through we've seen after that. Now that we've had this bit of a bounce post-gap, I'd love to see a follow-through above 70. That would really confirm the uptrend for me. And again, as much as I talk about breadth being concerning, as much as I talk about things that concern me, what's rewarding about what we do as technical analysts is that it's easy to find charts like Eli Lilly, LLY is making a new swing high. It actually broke above the 50-day moving average, pulled back to the 50-day, and now moving higher. The moving averages are in the proper order. The momentum is improving with the RSI pushing above 60. I love that chart. I think that's a great chart. The bullish divergence here in April, returning to the upside. Now I would argue I'm seeing more signs of an accumulation phase and maybe reasons to be optimistic. All right. Thank you, Edward Fairs, for watching. Man, I wish I had a way I can copy all the charts you have directly to stock charts. Hey, yeah, a lot of the charts that I share, I do actually share with my Market Misbehavior Premium members. That's one of the benefits I try to assign to them is like anything I show. If you want the chart, you let me know, and I'll show you how to save it into your login. I try to do some tutorials to help them use the platforms better, as well as part of that mentoring process. You are welcome to check it out at marketmisbehavior.com/premium. Would love to help you upgrade your charting game as always. Randall Brown, I love this the comment, invert the put call ratio. That's one of the things you can do. And if you followed my work, you've seen a lot of times I do invert series like the VIX, like credit spreads. I like to look at those upside down. You could also look at the put call ratios upside down, which all that means is then that the movement in the put call ratio inverted will match more closely the movement in the S&P. And that's a classic trick to like invert. When two series are inversely related, invert one of them, and then it can give you a much better sense of things. And I will tell you the easy way to do that. Now that I said, I'm happy to share some tips or some tips and tricks on stock charts. This is different on different platforms, but on stock charts, just put a minus sign before the ticker, and that'll easily invert the main ticker. And you can actually do that below here. You can put a minus sign if you're showing price data. You can do that. There's also invert main price scale on the Sharp Charts platform, and also on stock charts ACB. Other charting platforms that I've used, like Optima, like the good charting platforms, usually will give you the ability to invert the scale. And that's a common trick that's used by technical analysts when you're trying to just visually line up two different things. Inverting one of the scales can often be really helpful. At 3P Investor, thanks as always. I see a number of questions about just debating this idea that we're topping. And I think just echoing some of the comments you guys have been having here in the chat on YouTube. I would say this is one of those where not all the evidence is super negative, right? I mean, there are things that are not great. Stocks like Broadcom showing bearish momentum divergences. I would check that in the bearish column. Breadth indicators, absolutely bearish column. Offense over defense with consumer discretionary just significantly underperforming consumer staples. That's just pretty classic toppy bear market kind of signals to look for. But credit spreads remain narrow. The VIX remains fairly low. The indexes are going up, right? I mean, so there are things that still look pretty constructive here. So it really is mixed at the moment. What concerns me, and I think the negative outcome that I definitely see as a possibility, is that the euphoria dries up, right? I mean, when you have a bubble of some sort going higher, that's the concern, right? Is that the music stops and these stocks rotate lower. And that's why I think a chart like Broadcom might be a really helpful one to watch. Charts like that have been doing well, if they stop doing well, that's a concern. We saw that with Palantir. Do we see that with some of these other AI names? That is when these indexes could start going down aggressively. And that's what concerns me, is if that euphoria is no longer active, what holds these indexes up? There's a lot of daylight below those levels. Final question at Randall Brown. I'm not going to Oshkosh. If you know Kilo Oscar Sierra Hotel, Oshkosh, Wisconsin is this fantastic annual pilot gathering where people fly in. It for one day, one weekend, becomes the busiest airport on the planet. It's this little airport in Wisconsin, in Oshkosh, but they actually line 3 planes up at once, lining up on the different runways. I've actually never been to Oshkosh, but I sing in the Seattle Symphony. Quick story. One of my fellow bases works for Boeing, as a number of people do here in the Seattle area, and he went to Oshkosh for the first time last year. So at rehearsal on Monday, I was getting all sorts of great feedback on his experience going to Oshkosh. It is a bucket list item. I'll get there someday. I wish it was this year. It is not. Folks, have an awesome evening. Thanks so much for tuning in live. I appreciate you hanging with me on a late kickoff. Have a wonderful evening, and I'll be in touch with shows over the next couple days when I can. Be well, stay safe, and remember, it's always a good time to own good charts. Take care, folks.